Hello everyone, welcome to Car Conversations, episode 7 with your host Kurt here. We're going to be talking about do-it-yourself investments today and the pros and cons of choosing that option versus other options. So before I tell you how to do investments on your own, I want to take a step back and look at episodes 5 and 6. We talked about loaded mutual funds and annuities. So I made mistakes personally on loaded mutual funds, and I had many clients when I was a financial advisor make mistakes on annuities. And this all happened when I was young and they were young. So doing investments on your own when you're young can actually be a huge advantage to you. So for me personally, I made a mistake on loaded mutual funds when I went with an advisor who suggested and pushed loaded mutual funds because I wasn't going to provide them with much income based on the amount of money that I was putting in my investment. So a loaded mutual fund gave them a commission right away, and I was able to get into the market and have some exposure. But there's actually a much better way to do that than get loaded mutual funds, because you automatically start, 3.75% to 5.75% in the hole before you even begin. And on the annuity side, I had clients that were getting annuities when they were young, and the high expenses on those annuities were dragging down their returns every single year. So really you can get past that as well. You don't need an annuity when you're young unless you're over the income limit, which 99% of people are not going to be over the income limits of an IRA. So that's why I want to provide you with an option that I have done a ton of research on and can provide you with the basic steps of doing it on your own. During my time as an advisor, I was doing hundreds of hours of research on different investments. I also tried to create a portfolio that would beat advisors' portfolios. And it wasn't just advisors in my firm, it was advisors all over. And I was having a difficult time, and I could either match it or get slightly below, but it usually became a portfolio that was very difficult and no one would be able to do on their own. And then I kept coming across one fund that was either beating my portfolio and other advisors' portfolios or getting very, very close each year or over the long run. And that fund is called the Vanguard's Total Stock Market Index Fund. And the ticker name for that fund is VTI, so that's what I'll refer to it as. That fund was always consistently providing excellent returns in the same risk category as the portfolios I was putting it up against. It was always beating them if we include the advisor's expense that we would put on their portfolio. So when you subtract that 1% or more off of their portfolio, the VTI fund was always beating it. So it's an excellent fund, and I couldn't find a different way to beat it with my own portfolios that I was trying to create. So it became even more simpler to do it yourself after I found that fund. So we know VTI is a fund that is capturing the total stock market index, but how does it actually compare to other funds and portfolios? Well, it's actually a single fund compared to a portfolio which has multiple funds built into it to create the diversification you're typically looking for. This fund in itself creates the diversification that you want because it's capturing the small cap companies, mid cap, and large cap, and then it's also grabbing the value companies, which are more developed companies, and the growth companies, which are a little more risky. So going back to that small cap, mid cap, and large cap, that's looking at the market cap of the companies. So when we're looking at the large cap companies, that's typically the large cap companies we think of internationally or even domestically that are like Coca-Cola, Walmart's, Amazon's, just the massive companies that have a ton of capital in them. There's also mid cap and small cap, which are just obviously smaller companies. And then when we're looking at that ETF, which is VTI, compared to other funds, it has an extremely low expense ratio of 0.03% internally. So this is on the extremely low end, and for the diversification you're getting, it's an excellent deal. So we know there are some major differences in VTI compared to other funds and portfolios, but how is it similar? Well, it really comes down to the risk versus return ratio and the diversification. The diversification we already talked about, so we know it's similar to portfolios in that way. But when we're looking at the return versus risk, it's really similar to the higher risk portfolios that are out there. And that's what we want for just starting out and investing, because we want to be capturing some of the higher returns that we do see out of higher risk portfolios. And this one fund captures that. So like I said before, it's doing just as well or better than advisors' portfolios because it has such low expenses. And when you do it with Vanguard, you really have no other expenses attached to that. It's just the internal 0.03% expenses attached to it compared to an advisor, which is either going to have a loaded fund with extremely high commission attached to it, or you're going to be getting a yearly expense taken out for the management of those funds. When I was doing my research on VTI, I wanted to make sure that it was comparable to the return of other portfolios and funds that are capturing the entire stock market and getting the diversification that we need. And it was about the same as I mentioned before, which is around 5 or 6%, depending on how long term you're looking and what time period you're looking at. We're currently in the largest growth period in American history in terms of recovery. So since 2008, we've been on more or less of an entire growth period, and this is not usual. So usually we should expect a drop at least a couple years ago, but we're still on our growth period. And I see all over the internet and social media that people should be looking for 10% returns, and if you start investing, expect 10% returns out of your investments as an average over the years. And that's really not realistic, especially for the stock market and looking at the total stock market as a whole. You should be really looking for more like 5 or 6%. That's realistic. I don't want you to get unrealistic expectation of the stock market, because it's really not going to get you 10% on average every year. When we look at long periods of time, that's the best way to determine how a fund or portfolio is doing over past history. And you're likely going to see 5 or 6%. That's pretty usual and typical. And 10% is much, much higher and unrealistic. Over this recovery period that I was talking about since 2008, we've seen the portfolios and VTI itself getting much higher returns than 10%. And that's why I wanted to bring up the return situation, because I want to create some knowledge on this situation, because there are risks to investing. You're not going to see the returns that we've seen over the last 10 years consistently. VTI is an extremely high risk fund, and being in the stock market is a risk in itself. There's a chance of losing the principal that you put in, so that's the original money that you put in. If you start out now and next year we have a huge economic collapse, the money that you put in is going to be lower. It's going to be a lower amount of money in the stock market than what you started with. And I just want you to be aware of that and know that not every single year you're going to see positive returns. There's going to be years where it's negative, even months, or even decades. Sometimes there's decades out there where it's just a negative return decade. But investing's a long-term game. If you're betting on the American economy to do well long-term, you're going to get some returns out of this in the stock market. So I don't see America going away anytime soon, and I see a lot of innovation out of our economy, and that means returns are going to keep happening. It's just going to be different year to year, month to month. So going back to VTI and actually investing on your own, it's actually quite easy when you do it with Vanguard. I actually helped set a friend up with this, and you go on their website, you set up an account, and then you just start buying ETF shares of VTI. And when you're doing this on your own, you're saving yourself a lot of money because you are managing on your own, and Vanguard itself is not charging you very much. The fund doesn't have many internal investment expenses. It's 0.03%. But then, once you get older, you're going to start needing some planning. And planning comes from having an advisor. And this is when you can start switching some of your funds over to an advisor. But just remember, you want to be grabbing an advisor who's doing either fee-only planning, which they're charging you money to do a financial plan, or you're finding an advisor that is charging a percentage to manage your investments, and then they will provide a financial plan for you based on the fact that they are already managing your other funds. I know that investing on your own sounds difficult and scary, but once you go on Vanguard's website, they will walk you through the steps required to invest on your own. Another option is also just investing in your employer's 401k, which is another very low-cost option to getting exposure in the stock market. But if you have any questions for me on investing on your own or investing in your 401k, please feel free to comment down below. I would be happy to answer any questions you guys have. So this is Kurt, signing off.